At moments like this, you don't want to get stuck inside your own head. You need a cold, calculating, empirical approach to the stock market, which is why tonight we're going off the charts with the help of Carolyn Barodin. She's the brilliant technician who runs the FibonacciQueen.com website. She happens to be one of my colleagues at RealMoney.com, where I blog. Right now, she's raising the caution flag on the recent rally in the S&P 500. Why? First off, the S&P's already exceeded not one, but two of her upside price targets, to the point where she's thinking, well, it's getting overextended. Barodin says there's still a lot to like in the daily chart, but when prices get this extended, her methodology shows that moves tend to run out of steam, at least temporarily, something that wouldn't surprise me one bit. And the S&P's definitely feeling a little bit fatigued, as demonstrated by the weekly chart. So take a look at this, okay? Your fatigue setting in here. Before we get into the details, though, remember how Barodin's method works. She takes past swings in a stock or an index, then runs them through the prism of Fibonacci ratios. That's a key sequence that repeats itself endlessly in nature. Flowers, pine cones, snail shells. And for some inexplicable reason, does the same thing in the stock market. And it does, empirically proven. Her goal is to find key price levels or key dates where stocks are primed to change their trajectory. In terms of pricing over the last few weeks, the S&P 500 has already blown through two of her price targets. The first one at 4012, okay, right here. And then the next one was at 4090. These were her initial price targets before this whole rally started. In terms of dates, well, check out the daily chart. Barodin spotted two windows where a cluster of Fibonacci time cycles are coming due at the same time, meaning you're more likely to see this rally turn into a pullback. The first possible failure runs from yesterday through Friday, okay? We've got a cluster of 9 Fibonacci cycles this week. It doesn't mean the market will definitely roll over it, but it does mean there's a higher chance of a significant pullback within the S&P's broader uptrend. How about the second window? Okay, Barodin's also noticed a healthy cluster of these timing cycles in May. Remember, she does both. Okay, so this March, May. And what happens is, it shows you that we're not necessarily out of the woods, even if we've escaped this week unscathed. If we do get a sell-off, how bad could it get? Well, she thinks a pullback to 4012, the old ceiling of resistance, could easily be in the cards. And she wouldn't be totally shocked if the S&P sinks to the next floor of support down around 3720, 3,720. Well, that would be a big hit, okay? That's why Barodin thinks this is a good time to protect your profits. She recommends watching the daily chart. Her sell signal, okay, this is really important and is at the essence of what she's talking about. You have to watch the S&P 5-day, the blue line, okay, 5-day exponential moving average, and its 13-day, red line, exponential moving average. If the 5-day crosses below the 13, indicating that's the momentum turned against you, it's also your cue to get out of Dodge. So all this is about this looking fatigued and rolling over. And how far? Well, that said, even if Barodin's right that the S&P could be due for a short-term beatdown, remember that it's hard to swap out and then swap back in at lower levels. That strategy only works if you're nimble enough to pull it off. If you don't think you can get back in before the market snaps back, well, you're better off just hunkering down and trying to play through the potential pain. And that's what, she feels confident enough to make it so that you're going to have to get right back in, which is difficult. Personally, I like to split the difference. Sell part of your position, perhaps, but keep something on the table. And that's what we've been doing with my charitable trust, although we actually did some buying today. You can see all the moves by joining the ActionAlertsPlus.com club. The trust selling some, but not all.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.